Alright, good day everyone, and welcome back to my YouTube channel at Illumination Hub Energy. Don't forget to subscribe to the YouTube channel and also click on the notification bell so that you can be notified whenever I drop a new video. So today we're going to be looking at IAS 16, which is a continuation of the last video that I dropped. So you can check the link in the comment below. And also we're going to look at how to prepare accounts, okay, adopting accounting equations, or what we call mathematical equations, such as the present value formula, okay, where we have the present value equals to the future value multiplied by 1 over 1 plus r bracket 1 plus r n, this is our n, okay, or we can say future value fv multiplied by 1 multiplied by bracket 1 plus r bracket close raised to power n minus n, okay. So what we're going to do now is that we're going to look at do some workings. We're going to look at how to recognize deferred consideration. When we talk about deferred consideration, we're simply talking about considerations that are being delayed to the future, okay. When you buy an item now, instead of you paying cash, you are paying in the future, okay, which means you are being granted the advantage of paying later at a specific agreed period of time. Okay, so let us go into the video and do some examples in regards to deferred considerations involving property, plant, and equipment according to IAS 16. So let's jump into the video. We're going to look at some working today, most especially when we have the the value of the asset being deferred, okay, that is the consideration paid, okay, the consideration payable for the asset acquired, okay, being deferred to a future date. Okay, now when we talk about deferred consideration, we're talking about the amount that the buyer is supposed to pay in cash at the current day being deferred, being delayed to the future time as agreed upon between the buyer and the seller, okay. That is, the buyer and the seller must have agreed that, okay, the price, the money payable could be made, okay, at a given future time as agreed upon. So this means that the buyer of the plant, property, plant, and equipment can defer payments where he or she does not have cash, okay, to pay at the current day. So now let's just look at a given question that we have on the screen, okay, which talk about recognition of deferred consideration in PPE. So let's read the question. A company buys an equipment on the 1st of January 2024. The terms of the purchase are that the company will pay 10 million naira for the equipment on 31st of December 2025, 1 year after. Now, an appropriate discount rate is 6%. Recognize the transaction in the books of accounts in line with IAS 16. So what we're going to do now is that we're going to consider so many factors, okay, and that's why I said in my previous video that you need to understand mathematical computation, okay, which we now call accounting equations, okay. Now you need to understand those equations that you're going to apply for you to be able to get the value right, okay. So let us get into the solution. So let us go notes, we call that notes to the account. So we have notes. So notes, we have notes, okay. So number one, to calculate, we have been given a discount of 6% in the question, meaning that the current amount of the asset is different from what we are expected to pay in the future. We are expected to pay 10 million naira in the future, okay, but we need to determine what is the current value of that asset as at 1st of January 2024, okay. So for us, the formula for present value equals to the future value of the asset multiplied by 1 multiplied by R1 plus R plus R okay, 1 plus r raised to power n. So this formula can also be converted, it's for minus n, please, minus n. So this can further be converted into PV equals future value, okay, multiplied by 1, okay, all over 1 plus r raised to power n, okay. So where the PV equals to the present value of the assets of the equipment, okay, value of the equipment, the FV is equals to the future value, of the equipment. The R is the rate on discount, okay, of discount, or the discounted factor. We also call it the discount factor. We can see FV multiplied by the discount factor. So this here that we have here is the formula for discount factor. Discount, okay, factor. So where we have our n equals to what? The number of years. Number of years, okay? Number of years. So let us move on. Let us move on with the computation, okay? So we have been given the formula now, so we can go ahead and do the computation and proceed to the various books of account. So now, to compute the present value now, PV equals to, from the question, we are paying 10 million naira in the future. That's 10 million naira. 10 million naira multiplied by 1 all over bracket 1 plus R. Our R is 0.6 over 100. Let me put that for 6 over 100. So how many years will it take us? That is 1 year, okay? So therefore, 10 million naira, 10 million multiplied, okay, by 1 all over bracket 1 plus 0.06, okay? 0.06 raised to power 1. Okay, so this will further give us 10 million naira. So just breaking down the calculation, 10 million naira multiplied by 1 all over 1.06, okay? So when we add 1 plus 0.06, it will give us 1.06, okay? Therefore, we're going to have, so 10 million naira multiplied by, so what is 1 divided by 1.06? Okay, so let's do the calculation. 1 divided by 1.06. That will give us 0.94. Okay, that will be 0.943. Okay, 0.943. So let's just multiply by 10 million naira now. Multiply by 10 million. Multiply by 10 million. 10 million multiplied by 0.943. Multiply by 0.943. So it will give us 9,430,000, okay? Approximately, okay? 9,430,000. 30,000. So at the end of the day, it shows that the current value of the asset, current value of the asset, okay? The asset is 9,430,000 naira, but we are going to pay 10 million naira. We are what? We are paying 10 million naira in the future. I hope you get that now. Does this mean that, assuming we had cash, okay, the value it will cost, what it will cost us, okay, to pay for this asset is just 9,430,000 naira. 9,400,000. And that's just what it will cost us, okay, to buy this asset. But because we are going to defer, so we are going to defer for 1 year, meaning that the seller of the equipment will take 10 million naira from us, meaning that there's an interest, okay? There's an interest element on the asset, okay? So now, let us recognize this in the ledger account, okay? So let us go. So the ledger account, we're going to have in the ledger account, So how do we post this in the ledger account? That is, we're going to what? We're going to what? Recognize the PPE. Okay, we have debit, okay, and we have credit, okay. So let's put the naira sign. So don't forget to do that, the naira sign, which is the currency, okay, the denomination. So let us now, so we have what value we're going to pay. That is 9 million. This is as at 1st of January. This is as at 1st of January. 1st of January, okay, 2024. 1st of January 2024. The value of the asset is 9,430,000. Because we are not paying cash, okay, it's a liability on us because we are owing, okay. So we credit as well as a liability. We credit liability, debit asset, and credit liability. Okay. So what we have 9,430,000, okay. 9,430,000. So that's how we're going to recognize that on 1st of January 2024. Now, how do we recognize the interest? Okay, let's just now go ahead and do some working again. The interest element, okay. The interest element on the asset, okay, how do we recognize that? Okay, so the interest element at a discount of 6%, okay. So we now see the recognition of interest. Recognition of interest on the asset, okay. Recognition of interest element. So let me reduce the recognition of interest on the asset, okay. So let us move on. So we're going to multiply the 6%. Let us write this down, recognition, okay. The recognition of interest element on the asset of 6%, okay. So let us work on that to get the value of the interest payable on the asset. So recognition of interest. So interest would now be what? The current value, okay, which is 1,430,000 multiplied by 6%. 9 million. I think the network is low, so this is taking time. 9,430,000. 430,000 multiplied 30,000 multiplied, okay, by 0.06. 6% is also the same as 0.06, okay. So I'm just take this, so this is just 9 million, not 99, okay. So what's the value of that? So let us multiply that by 0.06. That is 565,800, okay. 565,800. 565,800. 565,800. 565,800. So let us check the figure out. So 9,430,000 multiplied by 0.06. Okay, we're going to have an interest. Okay, interest of 565. Okay, 800. So let us add this together with the interest rate. That is, let's see if the answer is correct. That is, so the amount payable. Let's also check. Just check this out. 9 million. Okay, 430,000. Okay, plus 565, 800. Okay, this will give us 9,995,800. Okay, you can see that it's not up to 10 million. Then there's an approximation error. So let us check out where the approximation error is. Okay, so we have 1 divided by 1.06 now. Let's just go back here. Let's go back here to check why we have an approximation error. 1 divided by 1.06, okay, will give us 0.943396. Okay, because we said 3396 should be 3396. Okay, that should be 943396. Okay, 943396. Okay, for 3396. Okay, 2264. So we need to confirm this. So 0.943396. Let us approximate this. This should be 0.94. Approximately this should be 0.9434. 0.9434. So let's check that. So 0.9434, 434, 434. Okay, let's write that this way. 34. 34. So let us multiply that. That is 9,434,000. 9,434,000. Okay, that is 9,434,000, not 430,000. 9,434,000. Okay, 434,000. It's like the network is poor. So 9,434,000. So now, so let's get the interest. 9,434,000. 34,000. Okay, multiply by 0.06. Okay, that is 566,040. So let's say approximately 56 based on the so let's say this will be 9. So we have approximated there as 9,9434. Okay, so 9,434,000. So 9,434,000. Okay, so 9,434,000 at 0.006 because of the approximation. So we should be left with 565. Okay, so let us do the multiplication. That is 566. Okay, 9,434,000. Let me edit that. 434,000. So this is the way you're going to do, but just that the approximation issue that came up, that is 566 040 040. Okay, 40. This should be approximately, let's say 566,000. 566,000. Okay, 66,000. Okay, 566 6,000. So this is the amount of interest to be considered in the statement of comprehensive income. Okay, so this is the amount we're going to consider in the statement of comprehensive income as 566,000, and is also a liability because it's the interest we are paying on the deferred consideration. Okay, so we are paying that, and at the end of the day, we are still going to be paying the addition um, of the liability incurred as well as the interest, okay, payable, which will give us the total sum payable within 1 year. Okay, so let me just try to put that this on 31st now. Okay, so 31st of December 2024, 31st, 31st, 31st. This thing is too slow in responding. 31st of December, okay, 2024. So we have debit, okay. We also have credit, okay. So we are going to consider statement of income, other comprehensive income, statement of OCI means other comprehensive income. Please take note. OCI means other comprehensive income. So we're going to debit that with the value of the interest, which is 566,000, okay, naira. Okay, that is 566,000 because it is an expense. Okay, 566,000. Okay, now we're going to recognize also in the liability on the credit, that is 5 as a liability, that is 566, okay, thousand. So the next thing is to recognize that, okay, in the what's it called, in the statement of financial position. Okay, statement of financial position. Now let us just put that here. Statement, okay, statement of financial position, statement, why this thing is this slow, statement of financial position. Okay, so we have assets. Okay, under our assets, we're going to recognize when we make payment at the end of the year. Okay, we have the value as we have the value as how much, that is 10 million naira. Okay, that'll be 10 million naira. Okay, that's 10 million naira at the end of the day. So asset, that is PPE. 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 Oh, this thing is slow. PPE. I'm having issue with the network. Okay, so PPE, that is, so what's the value in 1 year? Okay, that is so let me put the naira sign. Also put the naira sign here. So that is 10 million naira. Okay, So under liabilities, let me just scroll that up. So under our liabilities, so you know that this asset is a non-current asset, okay? Non-current asset. So under liabilities, okay? Liabilities, we have balance. So liabilities are also going to go have that is the deferred consideration, okay, which is deferred consideration, okay, consideration, okay, which is an addition of the interest expense, okay, the interest expense and the balance on the asset, okay, which is addition of 5, that is 9,434,000, okay, plus the 566, okay, 566, which is the interest element, 566,000, okay, 566,000, which will give us 10 million there. 10 million there. Now this is more of like saying we have a creditor, okay, creditor. So you can see same as creditor, okay. The creditor, now let me break this down. The creditor, we have at the beginning we have 9 million, okay, 9,434,000, okay. We now say, let's say this one be interest expense, okay, interest, which is a what, in a current liability of 566,000, okay, 6,000. Just an explanation, okay. This will give us the same 10 million, okay, 10 million at the end of the day. 10 million. Because the person we bought from, we are not paid for the same as creditors. We also this is deferred consideration, okay. So at the end of the day, we have 10 million naira to be paid, and the value of the asset, okay, is also 10 million naira based on our computation, that is the initial sum at the beginning plus the interest element. So this is how we're going to compute this in our various books of accounts. At the end of the day, because we're going to pay this out, okay, our cash is going to be what? 0. Our cash is going to be what? 0. So let's say we have our cash, okay, because when you pay, based on what we say, when you pay cash for an asset at the end of the 1 year, let's say this is ledger, this is ledger account, ledger. Oh, sorry for the lateness in response, because I'm finding it difficult, using the tab and the network fluctuation. Okay, so let's say this is the ledger. This is the ledger. Okay, we have cash. Okay. So when we pay cash, okay, so we say, let's say debit and credit, okay, debit and credit. So when we pay cash of 10 million, when we pay 10 million, after that 1 year, okay, 10 million, after that 1 year, so then the asset, that is the PPE, what do? We debit the asset that we bought, same 10 million. 10 million. Okay. So mean that we say for every receiver there must be what? A giver. This is the giver, and this is the receiver. Okay. So mean that we have during that 1 year period that we have made the payments. So we defer for 1 year, and we're going to pay in 1 year time. Okay. So we're going to be depleting our cash by 10 million naira, and we are going to increase our asset by 10 million naira in equipment. Okay. So this is how to prepare this account. Okay. And subsequently, we're going to do another video another part of the video so that we can explain more on how to compute these things, okay, for your own understanding. So thank you for your time, and kindly send me comments for further improvements. And also please subscribe to the YouTube channel, and don't forget to click on the notification bell so that you can be notified whenever I drop a new video. Thank you very much for your time, and have a great day. Bye-bye.